Gentlemen, it's a great pleasure having you again here for our Q2 advisory board meeting. Jim Rickards is here. He's currently in the car. So you won't see Jim, you will just hear him. Jim, thanks for taking the time. And we've got a special guest, a dear friend of mine, Otavio Costa. Tavi, thank you very much for taking the time. It's a great pleasure having you here.
Well, thanks for having me. I look forward to this conversation.
Thanks, Tavi. I will briefly introduce you for if there should be any people that haven't heard from you. Otavio or Tavi Costa, he's portfolio manager at Crescat Capital and has been with the firm since 2013. He built Crescat's macro model that identifies the current stage of the US economic cycle through a combination of 16 factors. His research has been featured in financial publications such as Bloomberg, the Wall Street Journal, CNN, the Financial Post, the Globe and Mail, Real Vision, and Reuters. Tavi is a native of Sao Paulo and is fluent in Portuguese, Spanish, and English. Before joining Crescat, he worked with the underwriting of financial products and in international business at Braservice, a large logistics company in Brazil. He graduated cum laude from Lindenwood University in St. Louis with a BA in business administration with an emphasis in finance and a minor in Spanish. And he played NCAA Division I tennis for Liberty University. And I know that Tavi is also a big fan of Gustavo Kuerten, my very, very favorite Brazilian tennis player. So Tavi, bom dia. Thanks for taking the time. It's a great pleasure.
Well, thanks for having me again. Yes, I'm a big fan of Kuerten. And anyways, it's nice to talk to you, Ronnie and Mark and Jim.
Excellent. Before we start off with the discussion, just a little housekeeping. Yeah, we've been pretty busy in the last quarter. Again, we launched a new fund, a crypto gold fund that combines gold, silver, mining equities, and cryptocurrencies. So it's our sixth fund already. We are working really 24/7 on the upcoming In Gold We Trust report that will be published on May 27th. So it's a big team of more than 20 people crunching the numbers, writing, researching, layouting, preparing charts. We're really excited, but still lots of work to do. The title will be around the topic of monetary climate change. So Greta Thunberg will also love the title, hopefully. It will be published, as always, totally for free on our webpage on May 27th. Then we did quite a lot of interviews recently. I think one of the most interesting ones was with Russell Napier, one of our most favorite strategists. And as you might know, Russell was in the deflation camp for quite a while, and he joined us in the inflation camp. And I think there was really a fascinating discussion with Russell about what's going on at the moment, combined with his deep sense and deep understanding of monetary history. And then, of course, we just published our new chart book on gold, the preview chart book for the upcoming In Gold We Trust report that will give you already some hints about the most important chapters in our new In Gold We Trust report. So I'd like to start with our special guest, Tavi. Tavi, you're from Brazil, but you're living in the United States for quite a while. And I have to say that I did quite a lot of presentations about gold during my career. And I remember one keynote that I held in Turkey, in Istanbul, where the asset managers attending my speech probably asked the very, very best questions. I've never got so many really thoughtful and smart questions about gold. And over the years, I realized that asset managers and in general people from countries with traditionally weak currencies and high inflation rates, they've got a completely different attitude when it comes to gold. For them, it's just natural to have gold as some sort of a monetary insurance in your portfolio. And this is completely different to the view on gold that people in the Western world have. So I would like to ask you, Tavi, how much did your background and your history from growing up in Brazil affect your thinking, and what's your general view, especially on the topic of inflation at the moment? Of course, it isn't such a contrarian topic anymore. We're seeing lots of interest when it comes to inflation. But I think it would be really interesting to hear your thoughts as a Brazilian, but also as an asset manager based in the US now.
Sure. Well, look, I think we've seen many times throughout history, at least when I was growing up, issues with the Brazilian real and even prior currencies prior to the real. And so I've seen my dad having to buy a motorcycle in order to protect himself against inflation at the time. And yeah, no, my dad is not a market practitioner or anything like that. And for him, that was a desperate move that actually worked out very well. And so when you see this type of desperate moves to get out of a currency, of a local currency like the Brazilian real, it's certainly has been a concern of mine growing up, looking at policies in general that we see, especially in places such as emerging markets that have a political weakness compared to a lot of other areas. And that's why when I hear about hyperinflation in the US, I have to say that I think it's a bit extreme relative to what we see in places like Argentina, Venezuela, Turkey, and you name it. Throughout history, we've seen a lot of those countries being devalued relative to hard assets. And one of the common theses that we hear a lot is the strategy of devaluing your currency to export more. And what people don't know about Brazil is that by doing that, it rises, it causes inflationary forces, and it becomes a negative feedback loop immediately as you are able to export a lot of raw materials, but Brazil actually imports a lot of final products. And so that feedback loop is very important. As it increases inflationary pressure in the country, you immediately see tightening, and that's when things fall apart very quickly. And so I hear that a lot. I hear that Brazil is an emerging market. It's been an emerging market for a really long time and never emerged to be a developed economy. And that's the joke about emerging market countries in general. So I think that really helped me as now a portfolio manager to really add that as part of our thesis. When you also do research in other parts in history of emerging market credit collapses that we've saw, sometimes you may see a currency fall apart. Maybe sometimes you may see a stock market have issues, even in local currency terms. But the most normal pattern that we see is that gold in local currency terms tends to rise significantly. And especially when you have a very weak political environment where the smart money of that country begins to leave. That's certainly what's happening in places like Argentina right now. Slowly, those are not quick developments. They take time to occur. So you start seeing the large firms exiting those countries. And over time, you start seeing a development like Venezuela. And so in Brazil, we're not as far as of now, but I still think it's a very overvalued currency relative to gold, relative to even the dollar. So it's as a fund, just quickly, it's always interesting to me not only to be long gold, but re-long gold against the most overvalued currencies we can find. And I think the Brazilian real certainly fits that category.
Excellent. And Tavi, what's your now tying in the United States? What's your sense? Regarding interest coming from investor and just talking to colleagues in the United States. is it similar like in Europe over here, that more and more investors, especially institutional players, are becoming more and more concerned regarding inflation, although central banks are telling us that it's only transitory?
Certainly, I think that has been one of the narratives that is more that has been prevailing recently. I would say that there are two narratives. It's almost like a collision of two macro narratives that are very important. One is what you're talking about, which a lot of people end up mixing things and talking about the roaring 20s that we're about to see, which I completely disagree. There are parts of the situation where, personal income and the households in the U.S. have certainly improved in terms of balance sheets, in terms of income, net worth, and so forth. All those things have actually improved significantly. But all we saw was a relocation of the macro imbalances from the private sector to the public sector. So the government is certainly a lot more levered, and we're going to see issues with that as well. So it's very difficult to see organic growth going back to normal. Going back to your question, it's very interesting how even if you look at Google Trends for inflation, it's spiking right now. And for a lot of mean reversion asset managers, that would be a time to do the opposite. But in my view, when you start seeing people hoarding money, or I should say hoarding hard assets, and that's one part of it, what we're seeing in Bitcoin. Certainly there is a side of speculation happening there too. But I don't think people are buying hard assets, especially Bitcoin, to go to the next coffee shop and buy a coffee. I think they're with it. I think what they're doing here is really, it's the general concern of inflationary pressure building up, given this combination of extreme monetary and fiscal policy that we're seeing really worldwide. And so, it is stealing the show a little bit from the precious metal side, but it's for any precious metals investors such as yourself, that is a dream to have all these macro factors that we have today with almost record pessimism in terms of sentiment. And so, I think there's certainly is in the rise here, this narrative of inflation, which is really a deflationary environment with a lot of speculative bubbles being met with truly unprecedented inflationary responses by the government. So, how do we go from here? I think it all falls down to that commodities to equity ratio. That's where it's right in between the narrative of the roaring 20s and the forthcoming liquidity crisis. And so when you find that ratio at a 50-year low, I think that's how you got to think about positioning yourself.
Great thoughts. Well, we want to bring in Jim at this point also. I think, Jim, we saw you tweeting that you've been active as always, and had held quite a few interesting presentations. I don't know if you can share some of your recent activities here. I think that would be really interesting for us and our audience.
Yeah, thank you, Mark. Yeah, no, I'd be glad to do that. Some of it is sort of the long, kind of long tail book publicity. My book came out in January of the new Great Depression, and you do a really intensive stage of interviews in the weeks around that. Obviously, book launches are like movies or plays. They can flop or they can succeed, but immediately. Like you can't flop and then have a success 2 weeks later. Your book's either going to take off or not. So you put everything you have into it. So here we are a few months later, and some of that I'm still doing interviews. The book's coming out in a lot of languages around the world. So Korean and there's Indian. Well, Indian will be in English, but it's being released there. So there's a lot of that. But I'm also doing quite a few consultations, some with hedge fund managers, some with other analysts, or just interviews that are not specifically book related. But I always say when things are going well, no one calls me. When things are falling apart, my phone doesn't stop ringing. So maybe that's a leading indicator. But I did an event yesterday. It was sponsored by the National Defense University, which is one of our leading military slash, it's under the Department of Defense, but one of our leading military slash national security academic institutions. This was a class. I was the a guest lecturer in this class, but they had about 700 people from 68 countries around the world. Very high rank. A lot of times I do this for mid-career officers, you know, sort of major, lieutenant colonel, and small seminar style groups. I do that for the U.S. Army War College. But this was, they said it was more high ranking admirals and generals from 68 countries. I asked the guy, if the Navy commander who was in charge of it, if they were all friendly countries. He hesitated a little bit, but then he said yes. But he mentioned Ukraine, so I don't know where those guys stand. But it was a big format, and I did get some questions, and the questions were interesting, including Bitcoin. I have to hand it to Tavi. Tavi's the first analyst I've ever heard refer to Bitcoin as a hard asset. I've heard Bitcoin's called a lot of things, but this is the first time I've heard anyone say it's a hard asset. So I got to think. I'm doing a consultation this afternoon on Bitcoin, so it gives me a couple of hours to think about that and see if I can factor that in. It's some kind of asset. I'm not sure I would say hard, but to Tavi's point, Bitcoin, even though people can't quite figure out what it's for, has taken on some of the characteristics of a safe haven. And I don't, whether I consider it that or not is kind of irrelevant. The fact is, in difficult circumstances, people, they will buy gold. They might buy treasury notes, but at least some people run to Bitcoin. So it's starting to get some of those dynamics, which is interesting. It's something to watch. But the biggest point of, I won't say confusion, but discussion right now is, are we, and this is what, you know, Incrementum does, what you guys do, is are we in an inflationary or a deflationary environment? Because if you just said inflation, here it comes, it would be very easy to structure a portfolio. You would just buy gold, you know, some hard assets, land, you'd lever up. There was just a set of things you would do that would be very straightforward. If you said it's a deflationary environment, it would also be very easy. You would have cash, government bonds. That's a little harder to understand. You would have a very straightforward solution. But what if A, you don't know, which is the most common comment I hear today, or B, you may get both in rapid sequence. And what I see right now is the latter. That is, right now today, we are in a deflationary environment or disinflationary environment. However, that may not last much beyond 2022. That by 2023, we may be encountering inflation that may last for decades, an intergenerational inflationary wave. And that's hard for people to process because, like, what do I do? Well, the answer is right now, a deflationary portfolio. That means more than the usual amount of cash. Treasury notes, yes. Utility stocks, yes. Other hard assets, etc. But prepare and be nimble for a profound inflationary wave that may be right behind it. So that's what I see. Now, coming back specifically to Tavi's point about gold, the market right now, there's no doubt about this, the market is anticipating inflation or reflation, if you want to call it that. And I've never seen a more perfect correlation between interest rates on the 10-year Treasury note and gold. Now, typically the dollar price of gold, it's a multi-factor analysis. So yes, inflation, deflation is a factor, interest rates, real interest rates versus nominal interest rates, geopolitical stress, supply, demand. There are a number of factors that go into it. But right now, today, I would say for the past 3 months, there has really been only one driver of the price of gold, which is the interest rate on the 10-year Treasury note. And it's been going up. The reason it's been going up is the one Tavi mentioned, which is the market expects inflation. Here comes the inflation. And so it'll go to a certain level. So the way I think about it, I'm very confident that the market has that wrong. That, I mean, the market's doing what it's doing. You don't want to stand in front of markets. It's like getting run over by a truck. But the inflation is not coming. The disinflation, deflation is so strong, but the market thinks it's coming. So one of two things is going to happen. Either I'm correct and the inflation does not
Jim,
appear.
I'm sorry, we can't hear you at the moment.
Oh,
it seems that the US needs a new infrastructure program.
Well, that's true. Can you hear me? Can you hear me now?
Now it's better, yeah.
Okay. We do. If you make a phone call from Kenya to Mumbai, it's perfect. You can hear a pin drop. In the United States, we have a third world telecommunications infrastructure. That's true. If the inflation does not appear, which is my expectation, and interest rates reverse rapidly, which is my expectation, the price of gold will go up very sharply because it's just the inverse of what just happened. We had 3 months higher rates.
Thank you, Jim. But I think I know what you try to say. I think it's yes, this correlation between the 10 years and gold has been very, very strong. Obviously, I think also the strength in the US dollar put some pressure on the price of gold. But I think it's also the enormous run that we saw in Bitcoin that clearly stole some interest from the media and investors from gold. However, I think we're pretty much relaxed when it comes to gold because I think the fundamental picture is still very, very powerful. And you know, we crunched the numbers on some sentiment indicators. The sentiment is extremely bearish. So I think that's a very good setup. But I think one point that Jim mentioned is a very, very important question, because I think at the moment the market is primarily seeing reflation as kind of the Goldilocks scenario. But I think that inflation concerns for the longer term are not really discounted by the market yet. So I think the market has priced in inflation for the next couple of months to come, but we don't see any inflation scare for the longer term. Now the big question is perhaps this time it's real, and as you might know, we published this special report called "The Boy Who Cried Wolf," where we said, okay, people want were concerned regarding inflation already 2 times before, but perhaps this time it's real, and I think, and we will elaborate on that in the upcoming In Gold We Trust report. There are many reasons to that confirm this view. Not only, you know, this interplay between monetary stimulus and fiscal stimulus, average inflation targeting, this MMT style policies that we're seeing. We're writing a special chapter about demographics and how it influences inflation. And of course, markets are screaming inflation. Just have a look at the commodity markets, especially real estate markets all over the globe, etc. So I think an interesting question would be, and I think Tavi, you have got a very interesting view on that. When is the level where inflation really hurts the general equity market? there was a study by Citigroup which said that this feel-good zone of positive inflation, or let's say reflationary environment, it ends at 2.5%, and then equity investors will get nervous. So what's your take on this, Tavi? Because I think that you've got a very pronounced bearish view on equities.
I do. And actually, I just want to separate. I'm not a person who believes in reflation. I think there's a longer term inflationary narrative building up strongly in the sidelines. This is not a healthy recovery from deflationary forces, which is sort of usually see as a recovery from a recession, which is usually the deflationary environment. To your question, there are a few things going on now, even using the bogus CPI number reported at 2.4%. Right now, if you look at Russell 3000 earnings yield, it's, in aggregate terms, it's actually for the first time since August of 2008 and since the peak of the tech bubble, at a negative level. So it's below the CPI. So it's companies are earning earnings yields are actually lower than the government CPI. The other thing I would point out is certainly positioning on inflationary trade or the reflationary trade, I should say, which is almost the same in terms of positioning, was very heavy. Right, we saw now sort of a breather from things like oil and copper that certainly had a decline in prices, a pullback since March, which I think it's healthy. It's very healthy. And so going back to your question about when the equity market is actually going to start bothering or get bothered by inflationary forces, I think it's very soon. And it's exactly why I believe and certainly that will be somehow a pause in this inflation thesis. My issue with all this is that it doesn't really matter. It's almost very difficult to see a deflationary bust in a place where you can print unlimited amount of dollars in a limited amount of any fiat currency. And so, we just had a family office blowing up here recently. If this was a story a decade ago, this would be a very important development for the market. It was not as important as I would think it would be. And so I'm certainly in the camp of having commodities, owning hard assets. I can only speak for my positioning. But at the same time, I do have a significant amount of hedges in the short side of the equity market, as I do not believe that most of the sectors currently justify those multiples through what we're seeing from an inflationary perspective. I don't think, when you look at the rate hikes, we're all talking about gold, how gold has not done well in the last 8 months or so. But it's also important to see the euro dollar market that is pricing in not only a full rate hike this year, but 2 rate hikes in 2022 and another 4 rate hikes by 2023. End of 2023. And so those are parts that are also being priced in precious metals today as well, in my view, which I highly doubt it that the Federal Reserve can even do that. And that's my whole reason why I think we might be triggering or entering a long-term inflationary problem. And to be fair, we've had 2 of those throughout history, in 1910s, in the 1970s. And what I'm referring to is if you use the CPI, which is not a perfect measurement, but even back in the days used to be measured, as you all know, perhaps a little bit more consistent with what was going on. And when you look at those 2 decades, the average or the annualized return for the equity markets was actually about 1%, even lower than that in the 1970s. And when you compare it with inflation running in the medium terms for the whole decade at about 6%, which, by the way, a lot of people ask the question, what about the 1940s? Well, the 1940s had the whole decade had sporadic increases of inflation, but the real inflationary decades that we had were 1910s in 1970s, where inflation was running above 6% on a CPI on a median basis for the entire decade. And so those 2 decades, we saw a very poor performance by the equity market. So I feel strongly that commodities will outperform equity market in the following years, and therefore the positioning here. And once you trigger and you enter this inflationary environment, it's very difficult to get out. I look at things in a probability terms. I think there's a high probability we may be entering one in the following 1 to 5 years. And so therefore this positioning.
Hey, Ronnie, this is Jim. Sorry to interrupt. I've been able to rejoin the call. I'm on my cell phone, so it should work fine.
Excellent.
Yeah. So I have a question for Tavi. In 2008, the beginning of 2008, the Federal Reserve balance sheet was $800 billion. Today, it's about $7.5 trillion. In those 13 years, we've had no inflation. So tell me what money printing has to do with inflation.
Yeah, that's a good question. I think that there's really 3 types of inflationary forces. The monetary dilution it could be one. The second one is that the combination of policies. The best answer for that is looking at what's happening with the household situation. The net worth for the bottom 50% of the population in the area that you're referring to, especially the post-global financial crisis, declined by 84%. 84%. Now we're seeing the largest increase in net worth in history in the middle of a recession that we just had, which looked a lot like a depression. So the combination of the fiscal and monetary policy is absurdly different from what we saw back then. And I think a lot of people using that as an analogy of money printing does not create inflation are not looking at the full picture. The second thing that I would point out is what's going on with supply shortages in commodities. That is real and that's happening. And I think that's when you study what happened in 1919 during the Spanish flu. And so during that period, one of the things that came out of that development was that we saw not only wasn't an aggregate demand that was growing. It wasn't the roaring 20s going on during that period. What was happening was that aggregate supply was constrained and caused prices to reaccelerate and actually trigger a decline of the equity market of over 40%. Okay, so I think that that's the big difference. And the third thing is with that improvement. So we have the monetary dilution, the fiscal package here, which has no end in sight, as we all know. And the second part is the supply constraint. And now we have this improvement from a net worth perspective of also the U.S. bottom 50%. And I think that is coming from an emerging market. I know that the bottom 50% spends money. And I can factually prove this, that actually the bottom 50% balance sheet is actually improving in the last decade or so. It's actually in the best setup that they had in the last 10 years or so. And so, and that is the same case with any parts of the society. That is not to say there are not inequality problems in the US. I don't want to also sound like there are no problems in terms of that. But the inequality problems just actually exacerbate the need for further monetary and fiscal stimulus to help those folks, or I wouldn't say help, but I would say policies that are direct to the bottom 50%, which I think it's going to happen even more. So handling money to the population, that wasn't something we saw in 2008. That's new. That's something that is happening now. And so the policies that are in place are completely different than what we saw in the last decade or so. And I would just point out my last thing, which is commodity prices. Commodity prices have done nothing but gone lower and lower in the last decade or so. And finally, we're seeing a move here. That is just one factor. It's not the main factor, but it's one important one that when you start seeing investors worry about inflation and start hoarding tangible assets in case commodities, that's when you start seeing this inflection point for inflation itself. So I think that's where we are today.
Well, that's a long answer, but you mentioned asset prices 10 times and you never mentioned consumer prices once. And that's a typical Austrian kind of jiu-jitsu, which is, there is a lot of money printing. It is not showing up in consumer prices. That's what people notice. That's what the Fed uses for policy. If you want to redefine inflation to include asset prices, okay, but you have to state that. That's not the way analysts, economists, and policymakers think about it. They look at consumer prices. Consumer prices have gone nowhere. Asset prices have gone up. You're right. They may go up more. We do have asset bubbles. I agree with all of that, but that's not the definition of inflation. That's kind of a Peter Schiff definition of inflation. If you want to redefine the terms, that's okay, but we can't talk past each other. When most people say inflation, they're talking about consumer prices, and there has been no inflation in consumer prices. The net worth element, yeah, housing prices are going up, stock prices are going up. I understand all that, but that's not inflation. Those are possibly asset price bubbles, but it's not inflation as it's defined, except by some Austrians and Peter Schiff. Now, getting back to the spending, you used the word stimulus. There is no stimulus. And by the way, I don't really do concepts or theory. I actually look at data. The data is on the $3 trillion of government handouts so far, the COVID relief bills under the Trump and Biden administrations. Approximately 76% of it is either being saved or used to pay down debt. Economically, paying down debt is the same as savings. In other words, there's no new consumption. If I pay down debt, I might be paying off debt, reducing my balance sheet for consumption from a year ago or 2 years ago, but there's no new consumption. The only 24% of the government handouts are going into spending of one kind or another, and that includes stock market investing, which isn't consumption. So there is no stimulus effect, and that's consistent with, the Reinhart-Rogoff theory that above 90% debt to GDP levels, more debt doesn't stimulate anything. So there is no stimulus, there is no spending, there is savings, and there are asset price bubbles, and there's no consumer price inflation. So the monetary and fiscal policy will both fail because of the already high debt loads, which inhibit spending, and the lack of velocity, which is the key to inflation.
Well, let me point out something. I mean, you said inflation is not in place. I mean, look around you. I mean, I know this has been a case for a lot of, as you mentioned, Peter Schiff. I'm not going to get into that because I don't have anything against him. But I know his thesis.
I do.
And what I'm trying to say is that's not my point from 10 years ago. I'm talking about today. I've looked around myself here where I spent my money. Everything is up at least 10%. The only thing that is not up about 10% is masks that you wear.
Well, people are highly selective. So in the United States, we're a dollar economy, largest economy in the world. The price of gasoline at the pump is up. It's up about $1 a gallon. I put gas in my car, so I noticed that. And people say, look at that. The price of gasoline is up. And it is. Clothing is down. Technology is down. Tuition is down. Healthcare is down. In other words, and quart of milk is up. So people tend to look at a couple items, but they don't understand that consumer price indices are baskets. They're fairly large baskets. And they tend to just sort of very selectively pick out one or two items that are up. That's certainly true. And they ignore all the things that are going down. I mean, what do you pay for clothing? I'll bet the price is down. I'll bet they're giving it away.
That's not true, actually. The clothing prices, especially in the last few months, have increased significantly. In
what currency? In what currency?
In the U.S. dollar.
No, they haven't. I mean,
I know it's up significantly. You can't find the same discounts you found back in March. Certainly in March, it was the case. We saw a dip, and then we saw, suits. You try to buy a suit back in the days, it was a lot cheaper. Not right now. Everything is up. Another point here, Jim. I don't want to force this disagreement by any means, but I would suggest you to look at the ISM manufacturing report from last Friday, where a lot of the executives were complaining about the fact that demand is surging. Meanwhile, we have supply constraints, and so prices are being forced to go up. In fact, if you look at inventories to sales for durable goods or anything you look at, it's declining. It's not rising. And so we can have a discussion from the past in terms of what happened throughout the last decade or so in terms of inflation, I think we're entering a different regime here, personally. And I would also point out the stuff you said about savings. Yeah, that's been true, but that's cash in the sidelines as of now. As of now, there's a bunch of cash in the sidelines to be used. In fact, they pay down debt. So their balance sheets improved in terms of the bottom 50%, the top 50%. You pick any parts of the society. That is not to say that we're going to see roaring 20s, which was an organic growth from a reflationary environment, on a disinflationary part where we came out from an inflationary bust. That's not the case here, and I completely disagree with that thesis. And I'm not here to tell you that I believe in that we're going through the roaring 20s. But I do believe. Yeah, go ahead.
Yeah, it's not a thesis; it's data. Two days ago, core CPI came in at 1.6%. Where's the inflation?
Yeah, it's funny that you're such a skeptic about governments, but you believe in government data. It's just,
well, if you want to say all the government data is wrong, then fine, we can live on another planet. But you can argue about forecasting and you can argue about trends, but that is the data. I don't think they make it up. Core CPI was 1.6%. That's what the Fed uses to guide policy. So where's the inflation? And explain to me. You agree that savings are up and people are paying down debt. That is in the data. But explain to me how paying down debt and deleveraging your balance sheet is inflationary.
Here's what you could do. Okay, so you take the CPI number and you strip, which is all offered by the Federal Reserve, strip out every single part of it, from food prices that are up 3.6%, while food prices are actually up when you look at agricultural commodities, and food prices itself, the index is up about 16%. Okay, so those are some of the differences. You can look at gasoline prices or just fuel prices that are being priced in right now, and the CPI number relative to actual commodities went up in terms of prices. If you strip out almost every part of the CPI number and compare it with what's actually going on, you can clearly see that there's some major divergences. Now, I'm not here to change the CPI calculation. I'm not here to claim for that. I'm just seeing this in the system. Am I saying we're going to see hyperinflation or anything like that? No, I'm not talking about that at all. In fact, in the 1970s, we didn't see hyperinflation. That was just inflationary environment. And we don't see those things because the political environment in the US is very different than in places like Brazil, Argentina, and so forth. And so I'm not saying that we're going to see anything like that, but I'm seeing some significant signs of inflation that are in fact similar to some of the things that we see in emerging markets, of grocery costs in general rising. We're seeing house prices rising significantly. The asset inflation that you were referring to, that is undeniable. And I'm not, we both agree there. But I do think that there's some significant forces going up that are not being reflected in CPI. That's pretty clear to me. I'll give you another example. Autos. Just look at the CPI for cars right now in terms of prices. And you look at used car prices or new car prices, both are surging. They're not up, 1 or 2%. They're surging. And so the difference is if you strip out any of the indices from the CPI versus the reality it's insane. So I do look at the data very in depth, and I don't think that that's reflecting what's really going on here. But you're welcome to.
Well, again, I don't do beliefs. I do data. Have you looked at the velocity chart lately?
Yeah, and I think that the velocity chart is a very important deflationary factor, and I don't disagree there. That's certainly
it's going straight down. It's going straight down.
Sure. No, it has been going straight down, and it's not recently as of very, very recently in the last quarter actually ticked up a little bit, but you're right. It's been going down. It's
been going down for 10 years. How much is $7 trillion times zero?
Okay.
Well, no, I'm serious. If you don't have velocity, if you don't have velocity, you don't have an economy. Velocity's been going down for 10 years. And in 2020, it was like an Acapulco cliff dive. It plunged almost vertically. Tell me how that's inflationary.
No, I don't think it's inflationary.
But I agree. It's it has stabilized as far as I had a look at the charts recently. And I think, one main point or one main difference between your views is I think that what's discounted for the future is not a big inflation concern, and obviously what we are seeing in the various indices is only what happened in the past. So the big question is what's going on in the future. And from my point of view is it's clearly once velocity continues to stabilize and rises again, and this would probably also go hand in hand with more confidence in the economy. So the whole COVID disaster, just gradually getting better. Then velocity should pick up, and then I think inflation will pick up. And I think I just heard an interview with Robert Kaplan from the Federal Reserve, and he's obviously one of the most hawkish ones. And I think listening to him, it was pretty obvious that they will completely tolerate inflation numbers overshooting. So I think the Federal Reserve is very, very open. They will tolerate it. Inflation numbers going up. They will continue to be very, very dovish. We're seeing that Janet Yellen or let's say the Biden administration, they are very busy coming up with new stimulus packages all the time. So I would say that going forward, at the moment, inflation isn't a big topic, but I think going forward, we have laid the foundation for rising inflation numbers.
Saying the Fed will tolerate it is an exercise in wishful thinking. They don't know how to cause it. I agree they'll tolerate it, but they're not going to get it. They're saying I'll tolerate something doesn't mean it's coming if I don't know how to do it. But the ISM indices, those are based on expectations and opinions. I mean, all the data you're citing are expectations, opinions, goals, and wishful thinking. I haven't heard anything that says that it's actually happening.
Well, have you looked at UN food prices? That's not an opinion. That's an index that prices the food and inflation in the system. Have you seen the car indices? I forgot the name right now of the actual index that shows used car prices. Those are actually,
you know why? Yeah, car prices are soaring. Do you know why?
Car prices are what? Sorry.
They are soaring. They're going up a lot. You're right. Do you know why?
Because of supply. It comes back to supply
side. No. It's because of demand. There's a major exodus from the cities. Millions of people are leaving cities in the United States. We're depopulating major wealth creation zones. And when you leave the city, the first thing you got to do is buy a car. I mean, I talk to car dealers, like real people who sell real cars. And that's what they say. The car prices are going up. You're right. But people are buying them because they're leaving cities. They're going to the country. They're going to other parts of the country. They're moving from New York to Nashville. They're going to Miami, Austin. There are destination cities. But the first thing you need is a car. And so those prices are going up. But the reason is incredibly destructive of wealth because we're depopulating major cities, which are wealth creation areas.
Jim, I think the major reason why car prices are rising is, in fact, supply problems. I mean, sure, the other factor you pointed out is a big deal. I mean, I actually know auto dealers here, and I know that's in fact what's going on is a major supply problem going on given the pandemic. Now, is that transitory? There's certainly parts of that is transitory. I don't believe, I think it's all about probabilities here. There's certainly a probability that we may see another deflationary bust. Actually, gold may do great, as you pointed out. I don't disagree there. I just think that from a probability perspective, when I look at even break evens, which yes, it is manipulated by the Federal Reserve as it is the largest purchaser of a lot of those securities. 5-year break even with the massive purchases of the Federal Reserve is at 2.5%. I mean, that's the expectation of where CPI is going to be. So having a deflationary view about the economy isn't so contrarian either. So,
well, what do expectations have to do with reality? The forward indices are usually wrong. They are what they are. I don't deny the data. You're right about the expectation, but what does that have to do with reality?
Well, that's exactly right. If 2.5% is what is expected, I believe there's a very high probability we could be running much higher than that. You're right. It's usually wrong. And that's exactly my point. And so going back to the money velocity issue you're referring to, I don't disagree there. I actually am in agreement. But as an asset manager, you shouldn't be looking back and saying you got to look forward, as Ronnie just said. And I think that there's a big chance we may see money velocity stabilizing and allowing inflationary forces to run a little higher. In fact, it's hard for me to see a total deflationary bust today. When you can just print dollars and fix almost any problem. And so, if we continue that way, and what we're seeing is policies against inequality, rightly or wrongly, that's what's happening. And that's certainly directly intervening on households' net worth, which is what we're seeing in terms of the bottom 50%. That's not an opinion, that's data. That's the largest increase in net worth of the bottom 50% in history. And so,
yeah, but Tavi, once again, you're talking about asset prices. That's not inflation. You keep talking about asset prices, net worth.
In fact,
you just said net worth. I said net worth is
the bottom 50%.
That's assets minus liabilities, which are asset prices.
Jim, the bottom 50% doesn't hold financial assets, as you should know. They hold some housing, which is a financial asset, about 30%. They have a lot of cash in the sidelines. They don't hold stocks like the.
No, I understand. I understand the housing prices are going up too. But again, you keep talking about net worth and asset prices, whether it's housing, stocks, commodities. That's not inflation. Inflation is consumer prices.
No, I think that's not. Well, that leads to higher consumer prices as a whole, because we know for a fact that the bottom 50% is holding a lot of cash. And so once the economy reopens, again, I'm not referring to a roaring 20s, but I think there's pent up demand, and I think that money will be spent, and it will meet an economy that has supplies that are incredibly constrained, and so it's going to lead to higher prices. Those situations of those are opinions from the ISM report. That's a very important opinions from executives telling you, it's also showing in their side of things. In fact, consumer suppliers inventories are plunging still. If you look at that data as well. So, anyways, I think I don't want to just I don't disagree with your positioning. It sounds like you have more of a deflationary view, and I actually I think that the biggest point for that is not only the money velocity side of things, but the speculative bubbles. And when they have a reckoning, that is deflationary, not inflationary. So I'm in agreement there. And the way I position myself in terms of portfolio is by being long commodities and by being short equity markets. Now, if that's going to be right or wrong, for the right or wrong reasons, then I don't know. But I'm looking at probabilities, and I think that's the most sound positioning I can find.
Perhaps we can talk about another topic that is somewhat related to it, and Jim, I would love to hear your opinion on that. I don't know if you saw the recent tweet storm by Janet Yellen, but she tweeted out some pretty interesting things, and one of them was, as I prepare to meet with my colleagues from around the world this week at the IMF and World Bank spring meetings, I find myself thinking back to the policymakers who gathered in Bretton Woods a year before I was born to define our post-war order. Jim, what do you make out of that? I thought that was a pretty interesting comment from Janet Yellen.
Yeah, well, you have to look at what Klaus Schwab said in his book about COVID-19, and I think it's called The Great Reset, something to that effect. This is the Davos, World Economic Forum. It's the G7 finance ministers. It's Madame Lagarde. It's the IMF. But they see the opportunity to restructure the international financial system. They've been talking about it for decades, but COVID has provided an opportunity for a lot of people to pursue a lot of agendas that have been on the shelf. So these agendas don't come out of nowhere. They're well prepared, well vetted, on the shelf. But what they wait for is the opportunity. This is what Naomi Klein calls the shock doctrine. You shock society one way or another, but then you use the shock to implement an agenda that you've had all along. You create fear, and then fear is a good way to get people to go along with you. Everything from these vaccines, which are actually not vaccines, to a global monetary reset. So we are having an issuance later this year of approximately $1 trillion of SDR, special drawing rights. Now, the number is, I think, 640 billion of SDRs, but at an exchange rate of $1.40 per SDR. The dollar equivalent is over 900 billion, close to $1 trillion. That's a lot. That's 5 or 6 times more than they did in 2009. It was a relatively small issuance. They've already made provisions. Of course, the SDRs are allocated by capital account, which means that most of them will go to the United States and the G7 economies because they have the largest capital accounts. But they've already made provision for secondary market trading in SDRs. And so the U.S. will get more SDRs than we'll just get the biggest share, 16.5% of the SDRs will go to the United States. But the United States can very quickly lend them back to the IMF, and then the IMF can lend them to more needy countries who can then convert them to dollars through the IMF trading desk. So the facilities are already in place to kind of turn them into dollars. But what they're trying to do, and you have to put this in the context of central bank digital currencies, the digital yuan, which is already out there, and the SDR issuance. And then, of course, the SDR is already a digital currency. So this is all aimed at basically diminishing the role of the dollar as the global reserve currency. And it's a globalist agenda. Janet Yellen is not really thinking of America. She's thinking of, as I say, this globalist agenda. But they're sort of going for it.
Actually, yeah, that's a pretty interesting tweet that came out, and I agree with your.
Hello, hey, Ronnie, can you hear me?
Yes.
Yeah. So I don't know if I broke up or not, or whether you heard what I was saying about Janet Yellen.
Yeah, we heard that. Yes, absolutely.
Okay.
We will have a special chapter on CBDCs in our upcoming report. I think it's a very, very interesting topic. So much research coming out about it, and of course, that's probably the next stage of the solution to all the problems, where you can pretty easily introduce negative rates and of course abolish cash and all those sort of things. But I wanted to before we end this, I wanted to ask Tavi, because Tavi, you're also very active in the mining space, and I am currently attending the virtual European Gold Forum, which used to be the Denver Gold Show Zurich. So I had, I think, 20 meetings over the last 2 days with management teams from mining companies. I've got a couple of meetings upcoming tonight. And I have to say that I sometimes feel like at a deep value conference. Companies are producing records amount of free cash flow. They are considering how to distribute it to their shareholders via buybacks or raising dividends. They've got very conservative price assumptions. So far the M&A activity made sense in most of the cases, I would say. So Tavi, what's your view on the mining space, and do you have any particular names that you like at the moment? I know you're working very closely with Quinton Henning, which is obviously one of the top geologists out there. what's your take on the mining space at the moment, and which parts do you like best at the moment?
Well, that's a good question. As you become constructive in the precious metal space, and especially underlying prices of the metals, you start looking for going up in the risk curve and searching for other opportunities. As I believe we're in the beginning of the secular bull market for gold, even though it started for gold itself back in 2015. But when you look at the miners really bottom now in 2020 with the pandemic, what I find interesting about this is that I think we're at the very early stages of a much bigger move for those companies. And so I like to be positioned mostly in the discovery and exploration side of the industry and some development businesses too. It's I would say a lot of investors that are in the same camp that start to be allocating more capital towards this industry. Most of those folks would buy the Newmonts and Barricks of the world and start going a little bit higher in the risk curve, and even trying to buy some of the developers. You know, there's quite a lot of financially savvy people trying to buy those companies. But where I think the real opportunity of mispriced opportunities in this market right now of precious metals really is in the discovery and exploration, given the lack of discoveries of gold and silver that we've had in the past, the supply cliff issue that we're seeing in terms of the major companies with a depletion of their reserves. We're seeing a capex has been contracting for over a decade. Now recently has a little bit ticked up, but it's not a real move that we saw back in 2010, 2011, leading up to the peak of the market. We're seeing, as you said, the major producers really being more cashed up, right? They're improving in the balance sheet terms. We're seeing free cash flow yield for the gold companies. They lost money for basically 25 years. When you look at the median free cash flow yield for those top 50 miners, they lost money for about 50 years straight. There was one incident in 2010 where they actually turned positive. This time around, we're seeing about 5 quarters of positive free cash flow so far, which I think that's a big change from most of the skeptics in the industry of avoiding this as an opportunity. And then we're seeing the free cash flow growth of over 130% on a year-over-year basis for those miners, and they're actually more attractive than even tech companies today, which I think goes back to your deep value idea. It's also sure it is a value opportunity, but embedded with a lot of growth in my view. And when you look at the balance sheets of those companies, we just saw the largest repayment of debt for the miners in history in the last quarter, in comparison to 2011, when we saw the largest increase of debt during the final quarter of the peak of the gold market back then. And so we're seeing balance sheets improvements, we're seeing free cash flow improvements, and our focus has been on the purchases and acquisitions of those businesses in the very early stages, or the left side of the Lassonde curve, as most of us all know. And so when you look at the size of the precious metals industry today at about $600 billion, and you compare that with a lot of tech companies today, that are much larger, single companies much larger than the overall industry, I find that very interesting as an asymmetric opportunity. And so I think there are strategic regions in the world today that we are, really bullish in terms of those discoveries. We have significant positions, activist positions in parts of the Golden Triangle, Newfoundland. We have, incredible positions in Nevada here in the U.S. We also have in other parts of the world, such as Brazil. Altamira is one of the investments that we have there that we like. Cabral is another one. Some other names in the Golden Triangle, probably one of the what we think it could be, SK number 2, which was a company maker for Barrick, or SK Creek number 2, I should say, which was a company maker for Barrick, is SK Mining, which is right south of Skeena Resources, where we're very bullish. We think that's they have another 8 or 7 VMS targets in that land package. Is about 500 square kilometers of land, and so in a very prospective region. And so we like to be long a lot of those gold miners through this left side of the sun curve, as I said. We have investments in Bolivia, such as Eloro. Eloro Resources is one of our largest positions as well. It's a very interesting play, probably one of the polymetallic deposit, probably one of the largest silver deposits we've seen. And there's a lot of tin as well. And so we're very involved in different deals where we're able to do so, participate through private placements, acquire some warrants, and we're very, I would say, I like to think that we're well positioned with about 60 companies that we have in our portfolio currently, that we have a very large involvement in general with Quinton Henney, which, as you pointed out, probably the most successful exploration geologist we've seen so far.
Still muted. Excellent. Some companies that I like very much as well. As you know, I'm also a member of the board at Tudor Gold in the Golden Triangle. We published one of the biggest initial resources over the last 2 decades recently. And yeah, I mean, just an open invitation to all our listeners to have a look at the webpage, to follow Tavi on Twitter. He's also very active. He puts out fantastic charts that we sometimes borrow with the thanks for that, great work. Yeah, so I think we're coming to an end. Jim, is there anything that is on your mind that you will that you would still like to discuss or let us know?
Well, first of all, I agree completely with Tavi on gold. So I'm an investor in a couple gold and silver mines, some publicly traded. So I'm going to refrain from mentioning any specific names. But with regard to the sector, yes, I agree absolutely. I'm extremely bullish on it. I think there are great opportunities there. Tavi's obviously done some great work drilling down, no pun intended, on a couple specific names. But I certainly agree with that overall analysis. The key with gold and silver mining stocks is, you know, as I say, gold is gold, geology is geology, cost of capital are about the same across the board. The big difference is management. So what I look for is really good management. People have done it before, perhaps had other successes, now running another gold mining operation. But again, stopping short of specific names, I agree with Tavi, and I also very much like the sector. It's a great opportunity.
Perfect. So, gentlemen, thank you very much. Obrigado. That's one of the very few things I can say in Portuguese. Thanks for taking the time, Jim. We made it over a proper phone call instead of a modern Zoom call. Thank you very much. Have a good drive. Tavi, thanks for taking the time. I hope that we'll meet each other in person in Denver or in Liechtenstein or in Vienna soon. Mark, thank you. You're still, you're muted. Sorry. You're still on mute, but we can read lips. So you just said and the Fed, right? All right, gentlemen. Thank you very much. Take care.
Thank you. Thanks, everybody.
Be safe. Be good.
Bye-bye.
All the best. Bye-bye. Thanks.
Bye-bye.